Hello, I'm Brian Ness. PwC monitors the comment letters issued by the SEC staff, and annually we publish our Comment Letter Trends publication series. Today, I want to give you a glimpse of that content by sharing 5 items that stand out to me. Perhaps keep these in mind as you prepare your filings. The first item on my list, Management Discussion and Analysis, MD&A, is the most significant area of staff comment across all industries. The discussion of a company's results of operations should provide insight into the underlying drivers of significant changes, even when those factors may offset and result in an overall insignificant change. There have also been comments related to the impact of current economic conditions, whether that be foreign currency movements or other macroeconomic factors. In liquidity and capital resources, there is a staff focus on discussing the underlying reasons for the sources and uses and cash flows, rather than simply repeating figures on the cash flow statement. We've seen comments related to disclosing events impacting liquidity, such as material debt agreements, covenants or restrictions, and the impact of permanently reinvested foreign earnings. Moving into my second item, in May 2016, the staff issued compliance and disclosure interpretations on non-GAAP measures. The C&DIs don't change the rules around non-GAAP presentation. Rather, they provide interpretive guidance, examples, and insights into the staff's thinking. The first thing to note is the concept of prominence. The rule states that GAAP measures should have equal or greater prominence to non-GAAP measures. In practice, however, this has not always been the case. The C&DIs provide a variety of examples of items that might be more prominent, such as placement on the page, larger font or bolding, but the key takeaway here is that GAAP measures come first. Next is non-GAAP information that excludes normal or recurring cash operating expenses. This is a facts and circumstances assessment where you need to exercise judgment. For example, in determining if an item is normal or recurring, a retailer that closes down stores on a regular basis is different from a manufacturer that closes a single plant in 20 years. Last is what may be referred to as creating your own GAAP, when a company presents an individually tailored recognition and measurement method. The example the staff used was a company that recognized revenue ratably over time in accordance with GAAP, and then presented a non-GAAP performance measure as though it earned revenue when customers were billed. Use of individually tailored methods will likely garner comment. It's important to note that this concept applies to all disclosures, not just revenue like the staff's example. The third item is segment reporting. The chief operating decision maker, the CODM, is responsible for allocating resources and assessing the performance of the entity. While often an individual like the CEO or COO, sometimes the CODM function is performed by a group. Recently, we have seen the staff request organization charts, listing of key meetings, and the roles of who attended to assess the identification of segments. Another area of focus by the SEC staff is the identification and aggregation of operating segments. The segment guidance only allows companies to aggregate multiple operating segments into a reportable segment if they have similar economic characteristics and certain other qualitative factors are met. 2 more items to go. The SEC staff continues to show interest in companies' internal control over financial reporting. This focus is based on the concept that disclosure of a material weakness should be a leading indicator of potential issues. However, in practice, material weaknesses are typically not disclosed until after a material error has been identified, which results in a restatement of the financial statements. We've seen questions from the staff on the existence or severity of internal control deficiencies when an immaterial error in prior periods is disclosed. In this situation, we've seen the staff ask for a timeline of when and how the deficiencies were identified and what the potential amount of the error could have been. Lastly, the staff's comments on SAB 74, which requires disclosures about how a new accounting standard will impact the company, include description of the standard, adoption date, method of adoption, and impact on the financial statements if known. For significant new standards like revenue and leases, assessing the impact can be a long process. As you progress, consider adding qualitative disclosures to help readers understand the status of the implementation and the potential impact the standard will have upon adoption. For more information on these and other comment letter trends, including sector-by-sector analysis, please refer to our comment letter trend publication series available on cfodirect.com.